Your gold, a safe place to store wealth, just dropped 6% this week, yet oil is ripping higher. Here's why the Fed is making you hold both bags. Markets closed Friday, July 17, 2026. Here is where everything ended the week. Like and subscribe for daily market updates. Today's agenda: the war trade, tech sell-off explained, gold's new reality, crypto under pressure, the oil crisis, market snapshot, Fed rate watch. That inflation pressure is crushing tech stocks next. War usually pumps crypto and gold as a safe place to store wealth. Not this time. Bitcoin sits near $63,000, bleeding, even though fighting in the Middle East is escalating. Gold also slipped toward $4,000 after hitting 6-month lows. Why? Because traders aren't looking for safety. They are pricing an inflation scare. Here's the mechanism. Iran keeps the Strait of Hormuz shut, while Ukraine has hit all 11 major Russian refineries. Brent crude jumped past $86, up more than 10% this week. That supply fear is real and immediate. Higher oil means a tougher Fed stance because imported costs rise instantly. The Dallas Fed president Logan calls for modestly higher interest rates to fight that exact thing. So what happens? Rising yields punish gold, which pays you nothing in coupons or dividends. It lifts the cost of holding cashless assets like Bitcoin and physical metal alike. This isn't panic selling. It's a calculated repricing of expectations based on inflation data coming out tomorrow morning. But gold isn't dead yet, just repositioned for a different world. The Nasdaq fell more than 1%, dragging the Dow and the S&P 500 lower too. Chip stocks like Nvidia, Micron, and Dell led this decline because earnings misses hit hard alongside global political pressure. Netflix reports after the bell next week, but today's drop was about something else entirely. Chip demand is cooling, while energy costs stay elevated. Oil prices are up 4.5% in a single session now. That means data centers face higher electricity bills and shipping logistics get expensive fast. I think this decline could accelerate if Netflix misses company outlook next week, but honestly, the pattern says it all even without that earnings miss yet. Investors are reducing risk because the underlying health of big tech looks shaky when energy prices spike like this. Bitcoin is facing a similar squeeze from this same logic. Here is the shocker. Gold fell toward $4,000, marking its worst week in 6 months despite war raging globally across multiple fronts. Traders are not pricing a panic bid for safety. They are aggressively discounting an inflation scare that threatens to anchor prices higher than anticipated. This dynamic immediately lifts real yields because investors demand significantly more return to hold cash or bonds rather than metals and other assets that pay nothing in nominal terms. The 10-year Treasury yield sits at 4.54% right now, and any further move up there crushes gold prices even harder by widening the opportunity cost of holding non-yielding bullion. I believe this drop was overdone to me given the asset's historical resilience during global political crises, but the mechanism behind it is simple math. If oil stays high, because Iran closes Hormuz or tensions escalate in the Strait, inflation sticks around longer than expected. That keeps rates higher for longer across the entire curve. Gold cannot survive in that environment unless real yields start falling fast to restore its purchasing power parity against sovereign debt. Historically, gold often rallies when central banks rate change quickly after a shock. But if sticky energy prices force policymakers into prolonged hawkishness, we could see a sustained correction rather than a temporary dip. For concrete investor implications, this suggests that simply holding physical metal as an insurance policy may be insufficient without hedging against the specific risk of elevated real rates persisting well past current projections. Oil is the real story driving all these moves today. A war should theoretically pump crypto as traders seek alternative stores of value during global political turmoil, yet the market is bleeding instead of rallying. Bitcoin sits near $63,000 while fear grips traders because the narrative has fundamentally shifted. Markets are reading this Middle East conflict primarily as an inflation shock rather than a traditional safe place to store wealth play. The mechanism behind this move is clear. Higher oil prices resulting from supply disruptions directly translate to broader economic pressure, which forces the Federal Reserve to maintain tighter central bank policy for longer. That prospect of sustained high interest rates pins Bitcoin down hard right now, crushing any speculative upside before it can even take flight. Ethereum pushed toward $2,000 resistance earlier, but failed to break through without warning signals from Wall Street analysts all day long. This mirrors historical patterns where big-picture economic data trumps global political headlines. Recall how crypto struggled in 2014 and again during the pandemic, when inflation fears dominated, regardless of regional instability. Solana dropped slightly too, because crypto available cash in the market dries up rapidly whenever the dollar index holds steady or rises significantly. The dollar index is currently at 100.75, barely moving down a fraction of 1%, while stocks tumble in sympathy with global risk aversion. That artificial stability in currency markets makes investors nervous about holding volatile digital assets when their primary hedge against inflation, the greenback, remains strong and expensive to borrow against. Consequently, capital flows out of risky tech sectors into cash equivalents rather than speculative tokens. This dynamic creates a second-order effect where even non-war-related crypto projects suffer from reduced venture funding and lower trading volumes as institutional investors wait for clearer signs that the Fed will rate change toward rate cuts before deploying fresh available cash in the market. Back into digital assets. Until oil prices stabilize or global political tensions de-escalate enough to dampen inflation expectations, Bitcoin remains trapped in a defensive posture despite its historical resilience during crises. Up next, market snapshot. Two converging conflicts are currently constricting the world's fuel lifeline with unprecedented severity. In the east, Iran maintains a stranglehold on the Strait of Hormuz, effectively threatening 1/3 of global seaborne oil traffic, while in Europe and Asia, Ukraine has successfully targeted all 11 major Russian refineries, crippling production capacity just as winter demand peaks. Consequently, Brent crude surged past $86 per barrel, climbing more than 10% within a single week alone. The immediate market reaction is stark. China was forced to hike retail gasoline and diesel prices immediately after oil spiked 12% in one trading session. This supply-side fear is not merely speculative. It is grounded in the reality that strong demand persists even as global political tensions escalate further, creating a dangerous mismatch between available inventory and consumption needs. Until global political pressure eases sufficiently to allow supply chains to normalize without interruption from strikes or blockades anytime soon, investors must brace for this friction between soaring energy costs and cooling inflation to persist well into next week's trading sessions. Historically, similar shocks in the 1970s triggered stagflation that lasted years. Today's digital economy amplifies these risks instantly across every sector. For portfolio managers, the implication is clear. Hedging strategies must account for volatile input costs rather than assuming a quick return to baseline pricing. The window for complacency has closed as markets digest the structural damage being inflicted on global energy infrastructure by simultaneous military actions in two distinct theaters. That brings us to Federal Reserve Rate Watch. Here is where everything ended the week in plain numbers you can act on today. Bitcoin sits at $63,912, essentially flat after a volatile session. Ethereum holds near 1,842 with minor gains, while Solana slipped slightly below $75. The S&P 500 closed lower at 7,458 points as chip stocks suffered big losses. Nasdaq fell more than 1% to 25,520, dragging the Dow down 2 by less than a percentage point each. Gold managed a small gain of 0.67%, despite falling toward $4,000 earlier in the week, because real yields stabilized briefly near their lows before rising again. Oil ripped higher to $81.78 as Iran cleared to sell crude temporarily, but fears linger over Hormuz closure. The dollar index held steady at 100.75, showing little movement while stocks tumbled. Here's my final take on where we go from here. Federal Reserve Chair Kevin Warsh recently signaled that current asset prices remain dangerously elevated, suggesting interest rates will likely stay paused until inflation shows a sustained cooling trend. This stance clashes sharply with Dallas Fed President Lori Logan, who is urging the central bank to implement modestly higher rates immediately to combat persistent price pressures. Such internal divergence among regional presidents creates significant uncertainty regarding the pivotal rate decision expected in July. Markets generally despise this ambiguity because it prevents investors from establishing clear positioning strategies ahead of the imminent earnings season starting soon. While I believe this market reaction appears overdone given the unpredictable price swings already witnessed, a potential shift could be catastrophic if Warsh doubles down on his "in favor of higher rates" message today. Such a move would likely terminate any existing rally within minutes regardless of what analysts predict otherwise. This dynamic echoes 2018, when conflicting signals from Fed officials caused sharp corrections before policy normalization took hold. The mechanism here involves bond yields rising prematurely, forcing equity how expensive assets look relative to earnings to compress as discount rates widen. Second-order effects include potential available cash in the market raising interest rates in smaller cap sectors, most sensitive to rate hikes. For concrete investor implications, this suggests a defensive posture is warranted until the Fed meeting clarifies whether the committee will rate change toward aggressive raising interest rates or maintain its hold strategy despite regional disagreements that could destabilize portfolio allocations before quarterly results are released next week. Markets closed Friday with a strange split that defies traditional war trading logic. Gold fell toward $4,000, while oil ripped higher past $86 as Iran keeps the Strait of Hormuz shut and Ukraine hits Russian refineries. This supply fear is real because higher energy costs force the Fed to keep rates high longer, crushing gold near $4,000, while tech stocks bleed too. I think this decline could accelerate if Netflix misses company outlook next week, but honestly, the pattern says it all even without that earnings miss yet. Investors are reducing risk because the underlying health of big tech looks shaky when energy prices spike like this. Thanks for watching Market Pulse Daily.